Welcome to Ideas of India, a podcast where we examine academic ideas that can propel India forward. My name is Shruti Rajagopalan, and this is the 2021 Job Market series where I speak with young scholars entering the academic job market about their latest research on India. I spoke with Kim Faye Cramer, a PhD candidate in finance and economics at Columbia Business School. She has a BSc in general management from the European Business School. We talked about her job market paper titled Bank Presence and Health, where we explored the various mechanisms through which bank presence and access to bank credit for both businesses and households impacts health outcomes in India. For a full transcript of this conversation, including helpful links of all the references mentioned, click the link in the show notes or visit discoursemagazine.com. Hi, Kim. Thank you so much for coming on the show. It's a pleasure to have you here.
Hi, Shruti. Thank you very much for having me. I'm honored to tell you a little bit about my research today.
Your research sounds very exciting because it talks about two things that we normally don't put together in the same breath. You are working on financial sector penetration. And in your paper, you're looking at this 2005 RBI policy in India, which is trying to incentivize banks to open branches in traditionally underbanked districts, right? And what you show is quite interesting. It's that financial sector penetration, or rather increase in access to banking and credit, actually improves health outcomes in these districts, which were, previously underbanked, and now they have improved in financial sector penetration. Can you tell us a little bit more about this paper and the mechanism at play?
Imagine that you live in a village or a small city in a developing country. There's no bank in your area. That means there's little credit access for businesses, and you yourself only have a low-income job. Now, somebody in your family falls ill with fever. You're concerned because you don't have enough money in your pockets from your job to pay for a visit to the doctor. Additionally, you cannot rely on your savings account, an emergency bank loan, or a health insurance payout, since these services are simply not available in your area. You also know that even if you could afford a visit to the doctor, healthcare supply is often scarce and of low quality. Ultimately, your family remains in poor health. Now imagine that a bank enters your area. First, the bank provides credit to the local businesses, which flourish, and you can benefit from higher income. Additionally, you can go to the bank branch and ask for traditional products such as a savings account and a bank loan. And very importantly, in the context of many developing countries, banks also directly provide health insurance products at the local branch. This is the case because banks act as intermediaries between health insurance providers, big companies in faraway cities, and the local households to decrease, for example, distance between the both or information asymmetries between the both. So either due to a higher income or due to increased financial access, you can now potentially increase your healthcare demand. And finally, banks potentially provide credit access for healthcare providers, which allows them to improve supply of healthcare services. So all these potential mechanisms could mean that your family recovers quickly and you remain in good health. The small narrative provides strong motivations that banks can play a vital role in improving health. Despite these strong motivations, we actually have no causal empirical evidence on the relationship between bank presence and health. And as you mentioned, what I'm going to show in my job market paper, I'm going to use a nationwide natural experiment that allows me to identify the causal effect of bank presence on health. So I'm using a policy of the Reserve Bank of India, the RBI, that was introduced in 2005 and is still in place until today. And this policy basically has the objective to increase bank presence in underserved locations. And in order to achieve this objective, the RBI relies on its authority to issue licenses for new bank branches in India. So now the policy states that banks can increase their chance to obtain a license for a favored location, for example Mumbai, if they strengthen their presence in so-called underbanked districts. Okay? And an underbanked district is what allows for causal identification in my paper. So an underbanked district is defined as a district that has a very high population, but a low presence of banks. So that has a population over bank branch ratio that is larger than the national average. At the same time, districts that have a ratio of population over bank branches that is lower than the national average are called bank districts. So we have underbanked districts just above the national average and bank districts just below the national average. So actually the design of the policy allows me to apply a regression discontinuity analysis in which I compare districts that are just underbanked, so where banks are incentivized to open extra branches, to districts that are banked. So in these districts, I observe health outcomes a couple of years after the policy. So I use multiple household level surveys, 6 years after the policy was introduced and 10 years after the policy was introduced. So first I show that these underbanked districts indeed benefit from increased bank presence. So these banks really set up more branches in these underbanked districts. Okay? And then as a next step, I show that household health improves. And I find that households are a third less likely to receive an illness such as fever, diarrhea, or cough a couple of years after the policy was introduced. Okay? So their health status significantly improves. And it also improves along other dimensions, such as increased vaccination rates or decreased risks associated with pregnancies.
So, I want to understand that there are many channels through which, financial sector penetration improves health outcomes. But can you maybe give us an insight on which are the dominant factors or which are the more prominent or salient channels? So what I mean by that is a bulk of the work in your story being done by the economic growth that is made possible through financial sector penetration? So people get richer, so presumably they have access to more clean drinking water, and slightly better resources at the household level, so they get sick lesser and their children get sick lesser, and you see all these improved health outcomes. So that's one possibility. A second possibility is that now, because households themselves have greater access to banking and therefore savings accounts, they are able to smooth out their consumption. Right? So they can actually borrow and rely on credit for any health emergencies that they might have, or to, make sure that they have health consumption exactly when they need it, as opposed to putting it off, which also improves health outcomes. Is it because there is greater access to credit on the supply side, which is, directly for the hospitals in a particular given area, right? Or is it through greater access on the supply side because overall economic growth has increased and therefore the demand for hospitals naturally increases when overall economic growth increases? Or is it a fifth mechanism, which is, with increased access to credit and economic growth, the dual impact of that is going to lead more households to buy health insurance, right? So you can imagine all these different channels being sort of the bridge between, financial sector access and penetration and health outcomes. So which of it is it? And if it's all of the above, what's the story there on what's the contribution of each of these mechanisms?
So thank you very much for your question. Indeed, you're right. There are many potential mechanisms that could drive this relationship between bank presence and health. And maybe the first one we are thinking of is that banks stimulate business activity and households become a little bit richer. Now they can invest in health, right? So I indeed find some evidence that households become richer in my data. So that's one potential mechanism. On the other hand, we have studies that provide large cash transfers to households, very large cash transfers. There are actually studies in Kenya, and they show even if you give these huge cash transfers to households, there are no improvements in health or in the short and the long term. Right? So these other studies suggest that simply providing an increase in income, an increase in cash available, is potentially not sufficient to improve health. So based on that, I'm turning towards other potential mechanisms that could be at play, right? And the second one that you were mentioning was that households gain access to financial products, savings accounts, credit products, and health insurance. So let's first talk about savings accounts. So I do find that households are significantly more likely to own savings accounts after the policy. And this, as you said, could potentially help them to smooth their consumption. However, there are other studies, big RCTs, randomized control trials, that show that simply only providing savings accounts are not likely to drive major welfare impacts, right? So we think, yes, we do see an increase in savings accounts, But I don't think this is a whole story here, right? For credit, I actually don't even see that households take up significantly more credit. Okay? So it's often that some households take it up, but on average, not a lot of households seem to take it up. But what's really, really interesting here is the financial instrument of health insurance. So health insurance in this context is often directly provided by banks. And that's something that might seem a little bit surprising to many of us, right? If you're maybe in the context of the US, you think about that banks traditionally provide savings accounts or credit products, but health insurance is mostly provided by insurance companies. Yeah? So why exactly in this other context, why do banks provide health insurance? So to understand this, let me tell a little story. Imagine you're a health insurance provider and you're in a relatively large city in India. Right? So now you want to gain access to potential customers, but you have two problems. They're far away, right? And you know very little about them. So what you're going to do, you're going to partner with banks who are already present in these very far distance locations. And these banks help you to A, gain access to these potential customers, and B, also collect some information about these potential customers. For example, the banks have already verified the identity of these potential customers. So that's the channel why we see that banks actually directly provide access to health insurance to households. Okay? So I think that's a very interesting story, and that's something that we haven't seen much in the literature about yet, that banks actually directly provide health insurance. And this could play a big role in improving the health outcomes that we observe. And then there is a third story, which I think is also very interesting and hasn't been investigated much in the literature yet. Banks provide credit to healthcare providers. So again, maybe if you're in the context of the US, you think of a healthcare provider, of a hospital as these big institutions, right, with many, many employees. But actually, in the reality on the ground, these are often relatively small establishments. Right? So what we understand as a hospital, they're on average, these establishments only have 6 employees. They're relatively small. There's maybe 1 or 2 doctors, and there's limited equipment, for example, to diagnose or to treat. Right? So these kind of establishments, they don't have unlimited access to resources, right? Imagine, for example, that healthcare provider wants to make an important investment. They want to maybe buy some equipment that would help them diagnose, right? So now this equipment is relatively expensive. So where banks come in, they provide credit to these healthcare providers, which allow healthcare providers to expand their and improve their supply of services, which ultimately benefits households. Okay?
So, here it's really interesting because you're right. India is unique in that the health insurance, right, coverage is also being provided through the banks, which normally only do financial intermediation, right? Now, what are some of the normative implications of this research? Is it that developing countries like India need to focus on greater health insurance coverage, right? With or without the banking sector, the government should announce big programs or it should subsidize these big programs because, the heavy lifting in the story is being done by access to health insurance, right? Which is also, of course, increasing the supply of healthcare. More people have health insurance, more small hospitals and clinics and dispensaries start opening up. Or is it that there is a very robust demand for health insurance? It is just a question of access and identification, and you need, something like a bank, which is a financial intermediary, to make that happen. You don't necessarily need large-scale government programs. So what's your hunch on, which is the policy direction that developing countries should take, given your findings?
So I think the area of health insurance is extremely interesting and very promising in this context, and that we're going to see a lot more research on this in the future. And actually, I have another project in Kenya on health insurance, right? So what I show in the context of my paper is that with bank presence, with increased access to health insurance, how health improves for households. But there happens a second thing, right? At the same time that health insurance increase, there's an increase to the credit access to healthcare supply, right? So it's basically going both through the demand, bank presence allows to increase demand and increase supply at the same time. And this could be potentially crucial part of the puzzle, right? That we need to increase both. So again, when we see, for example, only demand increasing because we just give cash to people, we don't see big improvements in health. But in the context of this study, when we increase both demand and supply, there seems to be a positive and strong and robust effect on health, right? So now your question was whether if we, like, say, expand bigger government programs and regular health insurance programs, how do they benefit households and potentially have the ability to also similarly improve health outcomes, right? So that's a question I think we need more research on, right? But it might be the case that simply providing access to health insurance alone is not sufficient because the supply side cannot react, right? So for example, imagine there's an increase in demand in health insurance. Now the gradual increase in healthcare demand, right? So the healthcare provider on the ground sees, oh, more and more people want to come in. They can now afford my services. They want to better diagnostics. At the same time, I cannot really provide these services to them because I do not have access to invest in proper equipment, right? So if the supply remains really low, a gradual increase in demand might not be the thing that we need to really improve health. Maybe it needs to happen on both dimensions.
Absolutely. What are some of your findings in Kenya? I'm just curious because, as an interesting comparison to the work that you've done in India, can you tell us a little bit about what's happening in Kenya?
So in Kenya, we're using randomized control trials, so RCTs, to investigate the question whether health insurance should be subsidized. So in my job market paper, I show that with increased access to banks, health insurance take-up increases. So this basically removes this first barrier of, let's say, distance or access to health insurance. But there are many other barriers, and one is the price, right? So we see that many households say that they simply cannot afford the health insurance. It's too expensive. So one question that arises is whether governments or other players should subsidize health insurance such that households can afford them. So this question depends on two considerations. First, it depends on how much do households benefit from health insurance. So we're going to do an impact evaluation. So one important outcome, of course, is going to be health. And the second consideration is, what are the cost implications of subsidies for health insurance providers? So because we do not only care about the customers, it also needs to be a sustainable system for the healthcare providers, right? So in particular, if you subsidize health insurance, that may mean that other types of potential customers select into the health insurance, or that they adjust their behavior based on the price that they paid. So we partner with an innovative health insurance company in Kenya to both see what are the benefits of health insurance and what are the potential cost implications of subsidizing health insurance for health insurance providers.
So is it simply a question of demand, which is, of course, going to be impacted by price and the subsidy that you offer, or is it also a supply side story? And I think that's a very interesting area of research. In India, particularly where private sector provides a bulk of the healthcare infrastructure that people rely on, right? Most of the hospital services are actually provided by small private sector, healthcare clinics and dispensaries. This is especially true also in terms of employment. Most of the doctors and nurses work in, private sector hospitals in India. So I think that is the part of the story which is critical, going forward, as you show.
I think you're right. The supply side is very interesting. And that's something I want to focus on in the future as well, right? So potentially we can really identify the causal effect of increased access to credit to healthcare providers on health status of households. That's something we almost have no research about. And interestingly, policymakers seem to be aware of that connection between banks and healthcare providers. So in light of the recent COVID-19 crisis, the Reserve Bank of India issued a new policy that basically is saying that banks should provide credit to healthcare providers. And this basically increased liquidity for healthcare providers up to $7 billion. So it's a very interesting area for both academics and policymakers.
Yeah. And, there is, I guess, I don't know how you would think about doing this, but, The COVID wave in India hit different districts at different points in time. So you see this massive increase in demand for healthcare services, right? Where the healthcare supply is not elastic. It doesn't adjust quite as quickly as demand in the middle of a pandemic. And there, I think it would be quite interesting to see what, bank presence has done in terms of an increase in demand for these, services. I think that would be an interesting area to look at specific to the pandemic, because it's one of those rare moments when you have the surge in demand without having an accompanying surge in supply, because, those processes are just slower.
Absolutely. Yeah.
Yeah. So, speaking about the pandemic, I know you live in New York City, you're at Columbia. I used to live in that neighborhood, by the way, on 117th Street on the other side of Morningside Park. What have you been up to during the pandemic?
Yeah, actually, so I moved back to Germany in the pandemic. I had the pleasure to spend a lot of time with my family. And actually, I spent a lot of time with my dog.
Oh, that's wonderful. What kind of dog do you have?
It's a Labrador Retriever.
Same.
Yeah. Oh yeah, very cute.
I have 2 of them.
Yeah, mine's a little bit orange. So we were taking very long walks. It was really a pleasure to just spend more time with my family and my dog. And he loved the attention. So
one last question before I let you go. What have you been binge watching?
Okay, so I was actually binge watching this show called Money Heist.
Yeah.
Yeah, it's about a robbery of a central bank, I think, in Spain.
Yes.
It's very fun.
Oh, that's fantastic. And yeah, where are you in Germany right now? Just out of curiosity.
I was located mostly in Berlin, but in the suburban area. So it was very rural. We have some wild pigs, a lot of forest.
That sounds great. No, I spent a semester in Hamburg when I was an Erasmus student. So I have spent a lot of time in Germany and I have lots of friends in the Hamburg area and I keep going back. But yeah, thank you so much, Kim. It was a pleasure to have you on the show. Thank you for making time to do this. And I look forward to reading more of your research.
Thank you very much, Rudy.
Thanks for listening to Ideas of India. If you enjoy this podcast, please help us grow by sharing with like-minded friends. You can connect with me on Twitter at @SRajagopalan. In the coming weeks, we will feature weekly short episodes with young scholars entering the academic job market discussing their latest research on India. Also, check out our new initiative commemorating 30 years of India's market reforms at the 1991project.com. The 1991 Project is an effort to revive the discourse on growth-centered economic reforms in India by focusing on the economic ideas that drove them. In the coming months, we will publish essays, data visualizations, oral histories, podcasts, and policy papers demystifying the Indian economy and the 91 reforms. You can see all the content and subscribe to our newsletter for updates at the 1991project.com.